Hello, Bigger Pockets friends. This is contributing blogger Doug Dow, joining you once again to discuss private money, this time 201, with securities expert Gene Trowbridge. Today we're going to talk about the Jobs Act, some of the changes to securities laws, in addition to how Gene scaled up his business with broker-dealers, and finally discuss private money and syndication. Is it really for you? Is it worth the effort? It sounds all rosy to raise money, but there are some downsides, and Gene will talk with us a little bit about that as well. I'm going to go ahead and jump right in here and fire away at Gene here. Gene, will you tell us a little bit about how changes under the new 506 have affected your practice?
Sure. Once again, hi, Doug. Happy to be here again. All right. Regulation D allows for private placements of syndications that cross state lines so that you don't have to register your offering with the SEC. Every security has to be registered unless it's exempt, and Regulation D is where we do most of our work. Rule 506 is where about 95 to 99% of the private placement money in the country is raised. Regulation 506 has always had a prohibition against advertising and general solicitation. You're supposed to work with people with whom you have a pre-existing relationship. The Jobs Act that was passed in early 2012 made really two changes in money raising. And the Jobs Act was all about jump-starting our economy and helping capital formation. As far as it relates to Rule 506, the Jobs Act basically bifurcated, divided 506 into two offerings. We now have a 506B and a 506C. This was all effective September 23rd of this year. So the 506B offering stays exactly where it was. You can raise as much money as you want from as many accredited investors as you'd like. In addition, you can have 35 of those magical sophisticated investors, but you can't do any advertising or solicitation. 506 was created, and 506C says you can raise as much money as you want as long as the sponsor is reasonably assured that all of the investors are accredited. You can have as many accredited investors as you like, and you can advertise and solicit. You can make offers through advertising and solicitation as long as you take the responsibility of confirming that all the investors are accredited. Now that's quite a change, isn't it, Doug? That might free up some money raising for the right type of sponsor.
It does seem to like open the game wide open in a certain way if you've got the right marketing mentality.
Yes, I think so. Here's what the SEC thinks. In the earlier call, I said that the SEC thought that maybe $1 trillion was raised in 2012 under private placements Rule 506. They think that could jump by 20% in 2014. Now, with the full effect of this rule, so that's another $200 billion. Well, that's a big number. My concern is that looking at my business, where the vast majority of our offerings, the people are raising $5 million or less. I think probably the average offering we have is somewhere between $1.5 million and $2 million. If we can't raise money from sophisticated investors, my money raisers are going to have some trouble. Because there's only about 8%, Doug. The IRS says with the elimination of your home in the definition of accredited investor and looking at the $200,000 and $300,000 annual limit amount, there's only about 8,000 households in the country who are accredited. Well, that's
wow. And Yeah, and going back to your last call, you made a stunning number, the amount of IRA money out there. How much was that from the conference, from the expert that you had tested at your recent conference? Talked about a stunning number of what's available in IRA money.
$5.8 trillion, and
With the T.
10% of the households in the United States have at least one IRA. But now there's only 8% of the households who are actually accredited. So I'm not sure that our sponsors who are raising money from individuals, normal individuals that they know, I'm not sure they're going to get a lot of mileage out of this advertising. I'm not sure they're going to give up the sophisticated investors with all that money in their IRA. You figure someone's got a $500,000 or $600,000 house that's free and clear, and they've got $400,000 or $500,000 in IRAs from all their rollovers, and they're in their 50s. Well, they're probably a sophisticated investor, and if you go to advertise for them, you won't be able to put them in your deal because they're not accredited. So I think that's a problem. Now, on the other hand, there are several of our sponsors who have always dealt with accredited investors and have a list of accredited investors and might even get into the world of some institutional or entity investors. Now, we didn't talk about that on the previous call, Doug, because I thought that was getting too far into the weeds. But there are about 16 different definitions of accredited investors. And if we get away from the simple definition of the individual or the single household and get into entities and funds that are formed, there's a lot of other accredited investor. And what I think the listeners here need to see that if there's a group out there that's been formed for a while and they have $5 million in net worth, by definition, that group is accredited. And I'm not talking about individually. I'm talking about, let's say I have an LLC and I've been in business for 4 or 5 years with this LLC, and I've got 10 investors in it, but the LLC has net worth of $5 million. That's an accredited investor. So some of my clients are going to advertise for that type of a group. They're going to go to financial planners, and they're going to go to investment advisors who represent groups like that. That might be kind of interesting. Now, let's say I wanted to put together a group to invest in your new deal, Doug, and I've got 4 or 5 people who would love to invest, but your new deal has $1 million minimum investment because you're looking for all accredited investors, and that's one way you're going to prove that they're accredited, that they can put $1 million in the deal.
Right.
But I've got 5 guys and myself, or 4 guys and myself, and we've each got $200,000. Individually, we can't invest in your deal, but I could put the group together and bring $1 million and invest in your deal. In that situation, the group doesn't have a $5 million net worth. The group was formed just to invest in your deal. You just have to underwrite each of us individually and make sure that we are each accredited. In my definition, we are. So you could take our $1 million and you could have advertised to find us.
Gene, I think on one of your previous discussions about this advertising, this is kind of an interesting approach that I really thought was genius when it comes to advertising. Maybe perhaps you go out there and advertise, and you may come across that sophisticated investor. If you do it properly, even though you did a general solicitation, if you put them in your database, can you somehow convert them later on, even if you are advertising, they happen to be sophisticated? Can you not indeed use that person you found in your advertising at some other point?
Sure. Let's go back to the 3 points that we raised in the last call about the direction to stockbrokers and financial planners from FINRA is that no offer can be made through general solicitation. You need to have a record-keeping system to make sure that no one who comes to you through general solicitation buys anything or invests in anything that you're currently offering. So let's play that game. Let's say I put together an offering and I'm looking for $1 million, and I decide that I want one investor. I want $1 million investor who's accredited, and I do every type of advertising you can think of. And I get a lot of contacts, a lot of people call in, but I restrict myself to finding that $1 million investor. I find that investor, I close the deal, and I do that deal. Now I've got all these people who came to me, okay, who are not accredited. I can develop a relationship with them, determine if they're sophisticated, determine if they're suitable, determine if they're interested in investing with me. And because I'm not having them invest in anything that I had offered currently at the time I met them, because that deal went and closed, right?
Right.
I should be okay. Now, there are some hoops to jump through, and I think you should get advice from your counsel, but I think that that is where this is going, and we're learning all sorts of new things about it. One thing I should tell you, Doug, is at the same time that they passed this, the SEC passed the rules and regulations that went into effect in September. They came out with another rule that's open for public comment, and after they receive their public comment, they'll decide what to do with the rule. And the rule has some restrictions on this advertising. You know, the SEC, if you're a securities regulator and you're trying to protect the public, the last thing in your world you want is wide open advertising on the internet. That's the last thing you want if your job is to protect clients. So they're going to come out and they would like to see some restrictions. One restriction would be if you're going to advertise, you need to submit your advertising to them, to the SEC, prior to it. You need to file with the SEC some documents before you make any offers. You probably are going to need to put some disclaimers in your offering material, and you're probably going to have to do some disclosures in some written document that might be more substantial than you would need to do if you didn't advertise. But today, as we're talking, that rule hasn't been put up for a vote. They're still taking comments. Congress is upset about that rule. Congress says, you know, hey, we passed legislation. The legislation said that accredited investors can be attracted to deals through advertising and solicitation. We didn't say go ahead and put all sorts of restrictions in it. So I don't know what's going to happen with that, but probably the most important thing is coming down the line, and we're already concerned about this. Dodd-Frank, which was passed 3 years ago, gave the SEC 3 years to research and revisit the definition of accredited investor. My guess is that, and a lot of people who know more about it than I do, think that if we don't get restrictions on advertising, the SEC will just come out and change the definition of accredited investor. And what we've heard they would like to do, and this was a couple years ago and it kind of went on the back burner, what we've heard is they'd like to make a definition that an accredited investor is someone who already has $2.5 million of invested capital. Now that's really going to limit the number of accredited investors, right? So they may make
I was going to say, Gene, not just the 1%. We're talking the 0.5% there.
Yeah, it's really going to make a difference. But what they could do is they say, okay, for an accredited investor, for Rule 506C has to meet this definition because of the advertising. An accredited investor with a pre-existing relation under 506B, we're happy with the $1 million and the $200,000. That's fine because you have to have a pre-existing relationship and there are restrictions on advertising. So, Doug, I think I'm in an interesting business at an interesting time, and we better keep our ears open.
Well, to that point, Gene, they also created something that seems like there's this mythical term out here. It's like got all the rage. It's called crowdfunding. Now, it seems to me the current crowdfunding real estate portals are, in fact, using 506 underneath their mechanism. But the rule also created a crowdfunding type scenario And it sounds like to me the way it will operate, it really won't be a practical use to any real estate investor. But could you comment a little bit on that, the new crowdfunding thing when it eventually comes into place?
Thank you, Doug. I think the problem that we're facing is vocabulary. The word crowdfunding has been around for a long time, and it's just simply a concept that really started in Europe, where people were able to raise money in very small increments from a lot of people to help them, let's say, develop a product. And people would invest $1,000, $2,000, and no one was worried if they were accredited. No one really cared. And the company went out and, gee whiz, they manufactured a product, and the people who had invested could buy the product cheap. Or they started a club, and the people who had invested could enter the club more inexpensively than the other people. And that's fine, and up to a certain point, you could never do that in 506 offerings because of the limitation and the prohibition on advertising and solicitation. But then the Jobs Act came along, and one of the provisions of the Jobs Act used the word crowdfunding. And how they defined what they mean by crowdfunding is pretty simple. They say in crowdfunding under the Jobs Act, you can go on the internet and you can raise small amounts of money from a lot of people. We're not going to worry if they're accredited. We're not. We may worry about how much of their net worth they can invest, and typically they said 10%, with a maximum of $100,000 per person. And the offering has to be conducted through a broker-dealer or something like a broker-dealer that's called a funding portal. And you can't do any of that stuff until we issue the rules. Well, today, if you go to the SEC website and you search on crowdfunding, you'll find a statement that was put up there in April 25th of 2012 that says, today, crowdfunding is illegal. You can't do this until we issue the rules, and the SEC hasn't even issued the potential rules. So as far as that type of crowdfunding, that's not available, but people have forgotten all about that. And I didn't even mention the most restrictive thing that you talked about, but we didn't put a number on it. All you can raise in the SEC's definition of a crowdfunding offering is $1 million. That's why it's going to be so darn restrictive. Sure, you can raise $1 million from 100 people with $10,000 each. But that's all you can raise. And so in some parts of the country that can do a real estate deal. For most of us, that's not going to work. But here's what you have now. You have people out there, and you see it in the newspaper. You see it, people go to workshops on crowdfunding, and they hear speakers on crowd. And I've been to all that. I've done all that stuff. And my message is, hey, what you're doing is you're just using a generic term to report the fact that you're actually doing a 506C offering, which allows you to advertise and allows you to take nothing but accredited investors. Because the people you hear talking about it and you read about their crowdfunding, somewhere in there you're going to see the word accredited investors. Well, that has nothing to do with what the SEC defined as crowdfunding. And then you're going to find that they're raising the money themselves. Well, that isn't what the SEC says about crowdfunding. So what they're doing is they're doing Reg D, Rule 506C offerings, which only has one problem. And you know, everyone has their own legal advice, and I'm not saying anything about this. I'm just saying that Regulation 506C wasn't effective until September 23rd of this year. And I think I've read, and I think I've heard, and I think I've seen people commenting on how successful they are under this approach prior to September 23rd. Okay.
That, if I were in their shoes, I'd be a little troubled by that statement.
Well, their attorneys, they have, you know, all these companies that are raising this amount of money have great attorneys and great legal advice, and I'm sure everything is fine.
It seems like the SEC really does not like the Jobs Act. Would you agree with that overall? They've really just struggled with it. Seems like they've just not had fun with that.
You may have seen an email, because you're in my database, that I sent out that I got a response from a commissioner in a securities commissioner in the state of Colorado, who my book is used at the University of Denver in their securities class, and he was teaching the class when the Jobs Act passed, and he sent me this email, and basically it says every fraudster who doesn't raise money using the internet should be convicted of fraudster malpractice.
Wow.
So and this is their job. Their job is to protect the public, and they think federally they think it's an issue, and the states think it's an issue because under Rule 506, the states have no control. They have no ability to prosecute. They have no ability to set rules. 505 and 504, everything you do, you have to register within the state where you're raising your money and follow all their rules. But in 506, for about 10 years now, the SEC has totally usurped all control. It trumps states. So here are the state regulators very concerned about this.
Absolutely, and it seems, it goes back to the, do you really want widows and orphans, they saved maybe 5, 10, 15, 20,000. Do they really need to be investing in deals like this? And
right.
I appreciate the counter argument.
Doug, one of the things that I tell my people, and this goes to a bigger thought, will blanket advertising be effective to raise money? I think it can be effective to build a database. And we talked about this on the last call, that the number 2 thing in order I think we should be doing is always building our database. So I think there's some benefit there. But if I'm thinking about the sale process, and, I was a syndicator a long time, and I worked with the financial planners and the stockbrokers, and we always had an approach on how to raise money in our private placements. And we went through this step process, and I called it the sizzle process. The first sizzle we had to sell was real estate. Can we find some people who really are interested in hearing about real estate generically? Because a lot of people don't want to play in real estate, okay? Then the next sizzle we had to sell is what was Gene Trowbridge's part in the real estate industry. And I had a very specific part. I was in the self-storage industry, primarily building self-storages to be sold to operators as I got them to a 50% absorption rate. Okay, so now if I'm still talking to you, Doug, as a potential investor, you're interested in real estate, you're interested in the storage industry, and you're interested in this development process, which probably has some economic ramifications. No cash flow, high risk, maybe we'll have great buildup of our equity, but it's not for everyone, right? And then I think what Doug would want to know is there any sizzle about investing with Gene Trowbridge? And what's Gene's track record? What has he done? I think that's pretty important. So far, I have not even mentioned the deal, have I?
Right.
Doug, I don't think I could come to you on our first call and say, boy, I've got this mini storage project in the desert, and we're going to build it, and we're going to go on construction loan with no permanent financing. We're going to build it, and when I get it 50% occupied, as I have in the past, I think I can find a buyer for it, and we'll double our money, and the minimum investment is $100,000. Are you in? I think I lost you at the beginning of that conversation.
Right. And if not before Bernie Madoff, certainly since Bernie Madoff, I would say.
As my wife says, why would anyone have invested in whose name was made off?
Correct. Absolutely.
So I think that's a great sales pitch, and that leads me to a discussion of, which one of my sponsors are going to be out there using advertising. Well, some of my sponsors have done quite a few deals would just like simply to do a mass broadcast to every investor they've ever had. That's advertising. And that's okay as long as they limit their investors who come in their deal to those who are accredited. Maybe they're going to do a mass broadcast to every investor they've ever had who's already filled out a document with them that said they're accredited. Well, you can do that. You can't do that under 506B. If you're going to take in sophisticated investors under 506B, you couldn't send an email to 200 of your past investors telling them about your new deal, because that's a solicitation. And I've got proof that that's what the SEC says about that.
Wow, that stuns me. I thought that was, for me, I just assumed once you have them once you have a track record with them, you can just hit them back up like that. That's actually stunning to me. I didn't know that.
No, that is problem. It doesn't mean you can't contact them one-on-one.
Right. You
just can't do a mass email. Yes, I'm aware of several cease and desist letters that were issued based on that fact pattern.
Good to know very much. Gene, I want to turn a little bit to really interested in your experience as a syndicator. I remember you mentioned something offhand about using broker-dealers as an alternative or a supplemental way to raise money. Let's say you're currently a syndicator and, man, you'd really like to scale up in the sales force, and scaling that up can be somewhat challenging. Can you talk about working with broker-dealers and how that might be an interesting way to add some folks that have a lot more contacts than you do, or is it a way to scale up?
Well, let's go to the basic rule. The basic rule is you cannot sell a security unless you're licensed to sell a security, with one exception. And the exception is similar to the for sale by owner rule in real estate. Like, you can sell your own house, but I can't sell your house. Unless I'm licensed. When you bring out your own syndication, you are issuing your own securities. And so to some degree, and you'll have to get advice on this on a deal-by-deal basis, you, Doug, as the issuer of your own securities, can go out and find investors and can sell those securities to investors under what's called the issuer exemption. But if you want to elicit anyone else to sell your securities, they have to have a securities license. So that's what you want to do. You want to go and find this huge sales force out there to raise money for you. I did. During my syndication career, after my first 3 deals, I ran into a regional broker-dealer who liked the idea that I was doing creative real estate for like some high-income investors. My minimum investment was always $100,000. My deals were local, and my deals weren't like anything else that you could find prepackaged on the streets. And so the broker-dealer said, we think we have high-income investors who would like to create some equity, and your deals are different. They can drive down the street. They can look at them. Bring your next deal to us and see what you can do, see what we can do. And I did, and I ended up doing the next 16 transactions I did. They raised all the money for me. Well, today the same argument goes, and we have clients who have a track record and have been able to go to regional money raisers in their market and convince them that they have a product that's unique enough that their financial planners and their stockbrokers were bound to have investors who would like that product and would like to be able to sell it. That's where it all starts. If you can't get the salespeople fired up about it, and they can't tell their boss that if we had this product, we could sell a bunch of it, no one's going to be interested. So in the situations we have, our clients are going to these regional firms. They're signing selling agreements, which is like a listing agreement with the securities firm, and then the securities firm goes out and raises the money. Two tracks in that flow chart. Some securities firms will only allow them to raise the money. They won't allow you as a sponsor to raise the money at all because they don't know what you're doing and they don't want to be part of a deal where you violated securities rules. So they want total control. That's okay. And then some sponsors are flexible enough that they will let you raise the money as an issuer. And I guess there's a third one. I'm working with one now where the issuer had 2 people who were key principals in their company, and the 3 of them were raising money, and The registered rep didn't like that idea, so the two people became licensed with the registered rep. And now they're all selling money under the issuer. The key principal is still doing it himself, but the two officers of the company actually are selling it under the broker-dealer network. So I think that's great. And I think today, if you have a track record and you have some financial stability behind you, starting out contacting people in your market, I would start with trying to find stockbrokers or registered investment advisors that are local to you. Sit down and talk to them about what your concept is, what your product is, what your track record is. It's going to take a while. So talk to them about a deal you're doing now that you aren't even interested, whether they raise any money. So they get familiar with it. And then when you bring out the next deal, as you're starting to bring out the deal, talk to them and get them involved, because they'll have some information and some ideas about how it should be structured if they're going to sell it. And you need to take them in right away to your conversation. But it's pretty exciting, pretty exciting. I mean, we used to do deals. We used to bring out deals, and in 5 days we'd raise $5 million.
Wow. That's a stunning breakneck pace there.
Yes, it actually drove me out of the business. I'll just make a real short story. My business was growing so much, and my financial planners came to me, and they wanted me to do bigger deals. And the size of the deal that they wanted, the deals they wanted me to do would have made me increase the size of my company, take greater financial risks, have more of my money up front for a longer period of time based on their promise, which was called best efforts. They never would guarantee you that they'd raise a penny. I never had any problem with it, but it was just so daunting and so frightening that it really made me decide that I'd done enough of this. And I went into an asset management, property management position for 5 or 6 years while I continued to run all my entities, sold the properties, made some money, got out of the business, and put on my lawyer hat.
Absolutely, and Gene, I think that's a great point that maybe is not really considered a lot. It sounds great. It sounds great in theory. Oh, I'm going to raise all this money as a syndicator, but as with everything else, there is a compensating price to pay for everything you do in this world, and I think that's an outstanding point. Is that you take on risk and a lot of responsibility if you're taking on this model.
Well, I think so, and if you were to come to one of my workshops, the first thing in the morning of the first day is, don't do this if you don't have to. Just don't do this. If you have plenty of money and you can buy all the real estate that you're comfortable with for your appetite with your own money, don't do this. Because taking on partners, getting into the securities world, takes you into a different business. It's something totally different than real estate. And most of your people who are listening to this call are real estate agents and brokers. This is a new business. You're no longer involved in running properties. You're in running people's lives. And not everyone is comfortable with taking a big chunk of money from an investor and shepherding it and managing it for 6, 7, 8 years. I mean, I used to have investors who had over $1 million invested with me in multiple deals. That weighs on you a little bit. And I will tell you, the care and maintenance of investors and partners can be overwhelming. On the year that we had our biggest output of K1s, we sent out 1,687 individual K1s representing over 850 investors. Not everyone can handle that mentally. And I got to a point where I wasn't interested in having 1,600 investors and sending out 4,000 K1s. I had just had enough.
Well, Gene, I will say, as for myself, for sure, I have been impressed with what you accomplished in the syndication arena, and thank you so much for dropping by to share your wisdom with us. We now will wrap up our call and thank everyone for tuning in. This is Doug Dow, contributing blogger of Bigger Pockets, signing off.